let's connect with him to understand that what he makes up of the news first and the impact it will have on Indian IT and in the Indian financial sector. Rahul, good morning. Thank you for joining us. Rahul, first, for our viewers, in very simple terms, if you have to really decode the news for us, what it means for financial markets, is this tip of the iceberg or the storm has come and gone and central banks have managed to contain the crisis?
Well, I think this was a crisis which was waiting to happen at one level. The world kind of got used to zero cost of money, and that can be quite an opium. Now, if you think about it, the world as a whole has, on a $90 trillion GDP, has $300 trillion of debt. This $300 trillion of debt was being funded. I mean, if you just say about a year ago, on the average cost of funding that debt was about 1% a year, which is $3 trillion. That number of funding that debt has changed to 5%, that means from 3 trillion, it's gone to 15 trillion just to fund that outstanding debt, which means an increase of 12 trillion a year. Now, if you imagine that the average duration of that debt is 5 years, that means that for 5 years you would lose another additional 12 trillion. So therefore, the present value of that debt outstanding globally has to be less at least by $60 trillion. Now, I've of course ignored the present value implications, but that would be just a rounding off error. Now, a very significant part of this debt and this bond portfolio and government debt, etc., is sitting on banks' balance sheets. Now, a lot of them are not being reflected because of the accounting policy of held to maturity. But even if you don't account for something, the economic cost is very much there, and which is what is leading to this kind of precariousness. And we saw this happen in SVB. SVB, to my mind, had much more specific challenges. Number one, I feel that as a bank, they did not manage rate risk. If you're holding a bond portfolio as a bank and you think that interest rates are likely to go up, and it was very clear to the whole world that we'd hit the bottom, you can do interest rate swaps and hedge yourself against that risk. You can also keep a bond portfolio with lower duration. You can also buy swaptions and different kinds of protections. And you can also increase your liability mix so that it matches the asset mix. SVB didn't do any of these things. So if you ask me, very sloppy treasury management at the very basic level. Two, you cannot buy, 10-year assets with overnight money. You can do it to a small extent of your book, but you can't have $80 billion of such assets on a $200 billion balance sheet. I think it was just, the MCO risk was not managed. The rate risk was not managed. So it was just, to my mind, very, very poor management. On the credit side, SVB also had, exposure to the venture debt market. The venture debt market basically lends to startup companies, etc. Right. I'm not sure what the exact size of their book was, but it was in excess of $20 billion. I think it was almost 25
$30 billion, yeah.
Venture debt book. Now, venture debt works brilliantly when, follow-on funding rounds are happening. But when you're lending to a loss-making business on the premise that the next round investors will come in and take you out, that's a fantastic strategy in a bull market. It's a fantastic strategy when interest rates are going down. But on the flip side, you tend to get hurt. Now, if you look at the risk-return profile of that business, you have all of the downside risk of the early stage ecosystem, but your upside is capped. So therefore, through the life cycle, you tend to get hurt. And you're just at that point in the life cycle now where you are going to get hurt. So
right, Rahul. So just to, thank you for that brilliant way in which you've just broken it down for our viewers. Now I'm going to come to something specific. At Bearing Private Equity, you have investments in IT companies. Now, IT companies have a direct implication of what will happen to the BFSI space, whether it is Credit Suisse or what's happening to American regional banks. In your understanding, what will be the impact of this for the Indian IT stroke BFSI space?
Uh, okay, let me address the BFSI bit first because it links to what I was commenting earlier. I think the Indian banking system is actually in a much better place than the rest of the world, and I think that's because we've been through a crisis. We've been through, the bad loan exposure, the balance sheets, and the equity base of a lot of the public sector banks being wiped out, therefore constraining credit growth, therefore constraining GDP growth. We've been through this cycle. We've come out of it. We're at that point in the cycle where a lot of the bad loans have been washed out, and we are actually sort of on a good runway going ahead. Now, the one thing that I'd like to point out from a global ecosystem is that when banks' balance sheets get impaired in this fashion, their lending comes down, and therefore that would also impact global growth. Now that global growth being impacted now I have to link that to the IT industry. That would definitely hurt the IT industry too. One, if you look at the large tech companies globally, the real challenge is that a lot of their revenue models or their models to capture value actually come from the advertising industry. And advertising is one of the highest beta industries in the world, which means that when you have a slowdown, the slowdown of that revenue tends to be much sharper. So that, you will see that short-term impact. Uh, in other impact, you will see, which is not related to this, but just fundamental to the nature of technology, is that it tends to eat itself. There is a degree of cannibalization. So if you see things like Chat GPT or Open AI and different kinds of AI platforms and machine learning interventions in the world, you will see that it will actually eat into a lot of basic repetitive work which was done manually. So
Right.
I think there is going to be a transition phase on both those counts for the tech industry too.
Sure. But, I just want to pick up on the recent most example, that of Credit Suisse, Rahul. I mean, 10 years back, yes, it may have been significant. I don't think anymore. But, more than anything else, it really seems that sentiment is really fragile, which is why, this sell off synchronized almost across the globe. What do you think can really change the sentiment? And I'm not talking India specific, pretty much across the globe.
Yeah, I think first let's look at Credit Suisse. Credit Suisse has always operated on the marginal credits. They were never, they were as a bank and as a franchise, they never operated on the AAA credits. They always took much more credit risk. And when you have a sort of, economic volatility of the nature that you're seeing and the kind of down cycles, these kind of organizations will get hurt. So to my mind, that was only to be expected. But as far as the fragility is concerned, you have a, like I said, the very large wipeout of the present value of the outstanding debt. A lot of that is on banks' balance sheets. I think people may not be able to understand it, in any form of detail, but intuitively they know that values got destroyed. So there is and to my mind, caution which is there correctly there, but also the slowdown in the ability to lend and therefore the broad money contracting from that perspective, and slowdown in economic growth. I think it has to make people cautious, and I think that's only appropriate. And I think that it's going to be a challenging times for central banks around the world to not destroy confidence. They will have to intervene much more. I think that the big risk the world runs today is that we have some degree of stagflationary risk. And I think that one has to sort of orient one's portfolios in that perspective. I mentioned earlier, India, I think, is in a different sort of part of that cycle. We do not have the debt to GDP issues that the rest of the world has at this moment. Our tax collections have been much more robust. We've seen a lot of cumulative economic reform the last 30 years, and I think you're seeing the impact of that. We have jump started on the technology front with digital stacks in governance models, etc. So I think you will see a lot of benefit and you will see a much higher structural growth in India. I think the challenge with Indian markets is a little different. It's that a lot of this upside is actually built into the pricing. And when the rest of the world is looking that much shakier, then that difference in valuations or pricing tends to look a little bit more stark. So my own sense is it's not that I expect any kind of major sell-off in India, but I do think that one will see pretty serious time correction. But if one has a 5-year view or longer in India, I would still be a buyer of equities.
So, what would you buy, Rahul? That's the next question from that 5 year long term view.
Um, yeah, and look, there are so many changes taking place, right? So, um, there are sectors, the China plus one, the manufacturing ecosystem. It's got to be a great opportunity in India. And if you look at the availability of workforce in the next decade, we are the only country in the world which has that kind of labor force available. If you take out countries like, Nigeria, Pakistan, etc., which are very tough to actually for any global manufacturer or company to base their supply chains out of just because of the uncertainty and the volatility associated with those countries, right? The transition from the IC engine to the EV engine, you're on a structural growth path. AI is another area which is, you can see around the world that that's going to significantly change things. Cybersecurity is another area where you get tremendous amount of growth, right? Engineering services, the world is moving to more and more defense expenditure. So I think you'll see a lot of these kinds of changes taking place.
So if let so let's talk about the stagflation scenario. If there is stagflation, that's bad news for everybody, and especially for equity markets. That's like the most scary scenario. High rates, low growth. If we are in for a stagflation kind of a scenario for next 12 months, 18 months, 24 months, then that will lead to serious equity or serious terminal value destruction in some of the companies. So should one be prepared for that? If 10, 15, 20% downside could happen?
Actually, Nikuj, I don't see that playing out because I think that to manage this issue with the banks, the sense I have is that central banks will not raise rates adequately to kill inflation. So you will have the possibility of negative interest rates, and in that environment, real assets and equity as a sort of asset class won't do quite as badly. So I am not. I mean, do I rule out some kind of serious volatility in the short term or sell off in sector specifics? Not at all. I mean, that can easily happen. But if I were to take a 5-year plus view, I think equities is still a pretty decent place to be in. And I think that if I look at all of the option set, real assets and equities is probably still the right place to be in largely.
Okay.
The levered part of the economy one has to be ultra careful about, right?
Okay. Let's wrap it up with the one comment, something which was our first question last time, but the mood of the market has changed, so it is the last question. When we interacted with you last time, we started by asking you a question on fintech and consumer tech. Today, that is the last question because the market mood has changed. What happens to some of these consumer tech and fintech companies? Because these are the companies where cash crunch will be there. These are the companies where growth will get compromised. The terminal values will change. Are we in for another bout of meaningful downside for consumer tech and fintech stocks?
Look, there are businesses in the fintech area which are solving real needs, capturing value, making a bottom line. I think that a lot of this acceptance of the fact that one could keep burning money because cost of money was zero, and whether you had cash flows 10 years later or 2 years later, it didn't really matter because your discount rate was close to zero. I think that has fundamentally changed, and I think that the old-fashioned wisdom that cut your cloth as cut your coat as per how much cloth you have. I think that's we need to go back to that, and I think we are seeing a significant portion of that. And I think that what will happen is that the good companies there is no shortage of capital for even today. And if you look at the amount of capital out there in the venture industry, the PE industry, the undeployed capital, there will be no shortage. I think people have simply gotten a little bit more picky. That whole thing of trespassers will be funded, which is the kind of environment we have lived through for the last decade or so. That is, to my mind, done and dusted, at least in this bubble cycle.
Rahul Bhasin, really appreciate your time, and thank you for brilliantly outlining all the important developments, what it means for India, what it means for our viewers, and what should our viewers do in this kind of environment. Where we got a full house from Rahul Bhasin